All right, so let's begin. Okay, so welcome to our today's webinar. This is going to be about basic things to know before you start investing. Okay, I am your presenter Sayed Mayuddin, and I'll be your host for today. So these are the agendas that we are going to talk. We are going to talk about today. Number one, investing terms or investment terms to know that you should be very much familiar before you start investing. Why should you invest? What can I invest in, or what can you invest in? Why diversification is the key, investing tips, and important investing facts to know. Okay, so these are the things that we are going to focus on for today. Now, starting with myself, my name is Sayed Mohyuddin, but most people call me Miles. I am an industry leading expert in recruitment. I have done recruitment for more than 10 years now. I have done recruitment in various different countries that includes India, US, Canada, South America, Australia, etc. Okay, I started my career as a junior recruiter, and over the last decade, I was able to climb the corporate ladder. And right now, I'm working as a head of operations and HR management. All right. So let's jump into our very first agenda, the basics of investment. Okay, you should know what to do with your money or learn what other people are doing with their money. Okay, so during this discussion or webinar, any time that you feel like you are having any questions, any doubts, or if you think like I'm going too fast, or if you're confused about something, please feel free to stop me and ask a question. Okay, don't be hesitant to ask a question. All right, so let's begin. Okay, so investment terms that you should be very much familiar with before you start investing. Number one, what is investment? Okay, the commitment of fund to one or more asset that will be held over some future time period, meaning whatever funds that you have are being committed or being given to one or more assets, meaning getting invested in either in a company or anything that is considered as an asset. So you have to keep in mind the difference between uh, product and an asset. Product is something that depreciates. Depreciates mean the value goes, the value goes down. For example, a lot of people think that cars are assets, but cars are not actually assets. They are products, because every year a car will lose a value, right? Lose some sort of value. So imagine a scenario. You bought the latest Mercedes GLA for maybe for 80 lakh. Okay. Next year, do you think that the car's value is going to go up? Is it going to become 90 lakhs? No. Next year, the car's value will come down to, from 80 lakh, it's going to come down to 60 or 55 lakhs. And again, within another year, the value will come down to 45 lakhs. The value of that car is going down, which means it's a liability, which means it's a product. It's not an asset. An asset is something that either increases its on its own value, or it supports in increasing other values. For example, education is an asset. Now you will think education is not going to give you money back, but education will help you get a better job, earn better salaries. That is why education is considered as an asset. Another asset is, can anyone think of an example? What do you think another example of an asset is? Anyone? Any guesses?
It's about land, you can say.
Exactly.
It's
Exactly.
shares.
Land is an asset. You can invest money in land. You can wait for a period of time, maybe 5 years, maybe 10 years, maybe 20 years, but the value is going to go up. Similarly, land, house, properties, all those things are considered as assets. Again, similarly, investing money in bonds, investing money in fixed deposits, investing money in retirement plan is also considered as asset because the value will go up. So that is what you have to keep in mind before investing, before spending your money on something, whether it's an asset or whether it's a liability. Liability is something that with a as soon as you purchase something, its value is going to go down. Imagine you bought a new iPhone. You took out the cover, you took the phone out of the box, immediately the value is gone. You might have spent 1.2 lakhs purchasing a new iPhone. If you even if you try to return it, you will get not more than 1 lakh rupees. You lost 20,000 rupees by just opening the box. So that is what you have to keep in mind. What is liability and what is an asset? Next, risk. Now, again, all these things come with risk. Okay, it's not like you can just purchase a piece of land. It's not like you can just purchase a piece of property, or you can invest in some sort of bond, fixed deposit, or any sort of mutual fund or plan. And it's not like tomorrow you're going to become rich. Keep in mind, everything comes with a risk. You have to judge, you have to assess what kind of risk you can take. Okay, so generally, all the investments are divided between three different categories, which are very obvious. Number one, high risk. Number two, moderate risk. Number three, low risk. Okay, things which are volatile, things are highly affected by the market changes on day-to-day basis, or maybe on hourly basis, or maybe on minute basis, are considered as high level risk. For example, again, a lot of stocks. When you purchase a lot of stocks, most of those companies are considered as high risk. Why? Because their value appreciates and depreciates on minute basis. That's why you have BSE, that is Bombay Stock Exchange, as well as NSE, National Stock Exchange. These are the people who who monitor the values of each stocks and bonds, and those companies are the ones who try to minimize the risk. But again, they try to minimize. I'm not saying they're eliminating the risk. There is always going to be a risk. Now, example of a medium risk will be investing in long-term mutual funds. Okay, where you might see medium risk, but since you're investing for such a long period of time, the risk goes down of losing your money. So let's say you invested 1 lakh, and if you want to withdraw that within a month, that's not going to be very helpful. That is not going to be very profitable at all, because that will be considered as very high risk. That will be considered as very high risk because within a month, a company's stock value can go down drastically. Let's say a company's share is like 500 rupees per share, and you purchase 50 shares that is worth 1 lakh rupees. Now imagine just 25 rupees drop. Okay, 25 rupees drop in each share. So that's going to be 475 rupees per stock. Since you have 50 different shares, that is going to be 25 times 50, meaning you almost lost 25,000 rupees. Okay, if you withdraw that within a month. So again, that is high risk. But if you're investing for a very long period of time, let's say for 3 years or 5 years or 10 years, imagine you have invested that money, you have invested 1 lakh rupees, bought 50 shares of a company, and you're waiting and waiting and waiting. Within a year, maybe the value went up by 10 rupees. Now you purchased for 500, but now it's 510. Next year, maybe it will go another 20 rupees high. Within 2 years, the value became 530 rupees. And again, within one more year, after 3 years, let's say the value increased by 50 rupees. Meaning, meaning, can you mute yourself if you're not speaking, please? Because it's going to create a lot of disturbance. Yeah. All right. So as I was saying, after 3 years, let's say the value is increased by 10 rupees, sorry, 50 rupees. The overall stock value will be 550 rupees now. If you bought one stock, You only made a profit of 50 rupees. But if you have bought, if you have bought 50 stocks, for example, imagine, then 50 rupees profit times 50 stocks. That's going to be, how much is it going to be? 2,500 rupees. You have made a profit of 2,500 rupees. That is how you have to think about that is how you have to think about the risk. The longer you wait, the lower the risk goes. And lastly, low risk assets are usually considered as within properties, because land value does go up. It fluctuates sometimes, maybe during the inflation time, or maybe during when the economy is very tough, but generally a land value goes up if you wait on it for a long period of time. So let's say you purchased a land or you purchased a house and you waited for 10 years, definitely that that assets value is going to go up at least by 30% if you wait for 10 years. Adjusting for inflation, you have still done a lot better. So that those are the type of products which are considered as assets. Is any questions so far? Now, passive investment strategy. This is another terminology that is constantly used in investment. Passive investment strategy. Okay. A strategy that determines initial investment portfolio and assets and make few changes over time. What does this mean? Basically, what it means is when you invest money in any sort of portfolio, maybe it might be a mutual fund or anything, how are they dividing their money? Okay, which assets are they investing? How are they choosing the type of companies they want to invest in? And how frequently are they going to make changes? All that process will be known as passive investment strategy. Now, usually you have money manager or funds manager or investment manager. They have different designations, but all of them do the same thing. When you invest in a mutual fund, you are generally assigned with a money manager or a funds manager or investment manager, because most of us don't have the time to research for ourselves. Most of us have our jobs, our education, or college, or whatever it might be. Most of us don't have the time to watch the stock market 24/7. So that is why a lot of times these banks will provide, or these mutual fund companies will provide you with fund managers or investment managers, or sometimes known as money managers. These people will do the research. These people are the one who will come up with the strategy, and these people are the ones who will inform you about the strategy, but you're the one who will have to decide whether or not you are going to invest or follow that strategy. Because at the end of the day, if you lose all of your money, the fund manager is not responsible. Fund manager is just there to advise you. Okay, so always keep that in mind. Active investment strategy. It is pretty much similar to passive, but here's the difference. A strategy that seeks to change investment portfolio and an or asset in belief that profit can be made. So in this method, same thing, fund manager will constantly make changes to make profit. They will buy something immediately which is which maybe has a downfall in price, maybe even by 2 or 3 rupees, and immediately as soon as the value goes up by 2 or 3 rupees, they will immediately sell that asset or stock or whatever it might be. So it's going to be immediate purchase and sale. And that kind of investment is known as active investment, where you're making small bits of money but immediate money. Again, that is also very high risk investment, so you have to keep that in mind. Now, here are a couple of more terms that you need to keep in mind. Direct investment. Okay, what is direct investing? Usually when you invest, you can either go through a bank or a broker or an investment company, or you can directly invest it. Okay. Now, investor buy and sell securities themselves, typically through a brokerage account. Now, You have to purchase your own demat or brokerage account. From there, you can directly buy and sell securities, which are stocks and bonds and equities. You can directly do that, and that is known as direct investing. Indirect investment. In this scenario, you will be going through different companies. That's what it says. The buying and selling of shares of investment companies, which in turn hold portfolio of securities, meaning you will go through a company who will decide where you're going to invest, and they are the ones who are going to hold the portfolio. Now, why would you go through a company and why would you go through direct investment? Keep in mind, direct investment is usually for people who are very much informed about the market, who have done their research, and who are constantly doing research. Investing is not something that you learn one day and you start doing from tomorrow and you don't have to learn. It is something that you have to learn every day. You will have to understand what's happening in the market, what is the trend of the market, which direction a company is going. A lot of time it takes 10-15 hours every day. People spend, investment bankers spend 10 to 15 hours every day trying to understand the market. If you have that kind of time or if you have that kind of knowledge, then you can definitely do direct investment. But most of us, since we don't have that much amount of time, we go through companies, we do direct indirect investment. Companies are the ones who will do the research. Companies are the ones who are going to decide everything, and they are going to help us make the profit. Now, there is also one disadvantage with indirect investment as well. When you directly invest, you don't pay any brokerage. But when you indirectly invest, you will have to pay for the commission, pay for their fee structure. Each company will have their own fee structure, which you will have to pay out of your pocket. So you have to keep that in mind. Now, someone said this quote: someone sitting in the shade today because someone planted a tree a long time ago. Can anyone guess who said this quote? Okay. This quote was told or narrated by Warren Buffett. Warren Buffett is one of the most successful investor in the world. He has made millions of dollars just by investing. Okay. Now, what he means by this quote is someone sitting in the shade today. If you go outside, you find a big tree. You can get shade out of that. Let's imagine it's a very hot summer. And if you go below that tree, you get a lot of shade. You get relaxation. The reason you feel relaxed is because someone planted that tree a very long time ago. A tree does not grow in a day, right? It takes years and years. Sometimes it takes 20, 30, 50 years for a tree to be fully grown, right? The tree does not grow in a day. That is how you have to look at your money. That is how you have to look at your investment. No one can become rich in a day. No one can be successful investor in a day. You have to invest your money. You have to wait. You have to wait. Warren Buffett, when he made his very first investment, he waited for 10 years before looking into what happened with his investment. He waited for 10 years without even thinking about it. That is how you have to wait. Your money is like a plant. Your money is actually like a seed, not a plant. You have to plant your seed and wait for it to grow. It will turn into a small plant and a small tree, and it will grow into a fully grown tree, but it will take time. It will take effort. Now, what can I invest in, or what can you invest in? Equities, securities. Okay. Generally, in our you know easygoing language, we call it as stocks. Okay, we call it as stocks. Usually, when you purchase stocks from a company or shares from a company, that will be known as equity securities. Now, Keep in mind, equity is very volatile, but at the same time, it can be very profitable as well. Now, imagine 30 years ago, 30 years from now, in 1990. Okay. If you would have invested, let's say, 50,000 rupees in Apple, today that 50,000 rupees would have become somewhere around 70, 80 crore rupees. Just 50,000. Because equities are very profitable, but at the same time, they're very risky as well. What if Apple had shut down in last 30 years? What if Apple faced a lot of losses in last 30 years? They're not a big company anymore. In that scenario, you can actually lose your money. Now, let's take another example. 30 years ago, if you would have invested in Yahoo, let's say you have invested 50,000 rupees in Yahoo, maybe in 2010, that 50,000 rupees might have become 1 crore or 2 crore rupees. But by now, in 2022, Yahoo does not have any value. Your 50,000 rupees could have become 5,000 rupees by now because Yahoo started losing its value. Yahoo actually shut down its business in India. Yahoo mails are working, but yahoo.com is not working in India right now because they have shut down their business in India. Most of their businesses are shut down across the world. Right now, they are only making money through Yahoo emails. Okay. So again, you have to keep in mind equities can be very profitable based on the company that you're investing and how the company is performing. At the same time, it can be very risky based on again what the company is doing and how the company is performing. If the company is performing really good, if it's going up, then your money is also going up. But if the company is doing bad, if it's going down, your money is also going down. Your money is losing value. It's not like you invested 50,000 and if the company is in loss, you will get your 50,000 back. No, you will get according to company's value. So always keep that in mind. Equity can be very profitable, but at the same time, equity can be very risky. It's a very high risk investment. Now, next is derivative securities. Usually these are optionals or future contracts. Okay, future contracts like maybe some sort of government projects that's going to come up. Again, these are considered as moderate risk, usually because government projects takes a lot of time, but generally they do happen. Worst case scenario, if they don't happen, then again, you are going to lose your money. Next is money market. For example, treasury bill or negotiable CDs. What does that mean? Money market security is usually, currency trading. Okay. You have treasury bills. Let's say you're purchasing dollars by spending rupees. Okay. Let's say last year, if you bought $1 cost somewhere around 74, 75 rupees last year. Okay. Let's say you bought $10 as investment. Okay. You had $10. You bought 75. Let's say each dollar you bought for 75 rupees, meaning you spent 750 rupees to buy $10. Now, if you sell those $10 and get rupees back, now the dollar value is 81 rupees. Meaning, if you sell $10 now and get your money back in rupees, you're going to get 810 rupees. Meaning, you purchased for 750 rupees, you sold for 810 rupees. Meaning, within 1 year, you made 60 rupees profit. And that is just an example for $10. A lot of time when people are investing in treasury, they are generally doing it for higher sum of amount, maybe thousands of dollars, sometimes even millions of dollars. Depends on the person, depends on what kind of investor they are and what kind of risk taker they are. And lastly, fixed income securities, for example, bonds and asset backed securities. Now, again, if you invest in bonds, generally they are fixed income, meaning you will get a fixed rate of, let's say, 3%, 4%, 6%. These days, FD rates are somewhere between 6 to 7.5%. But even if you look back 10 years ago, FD rate was pretty much the same. It was somewhere between 6 to 7.5 or 7.8% returns. Generally, fixed income securities don't change a lot, meaning you're going to get constant profit, but you're not going to get a lot of profit. The profit will margin will be really low. Some FDs even today only provide like 3% or 4% interest, meaning you're guaranteed that you're going to get 3%, but it's only going to be 3%. It's not going to affect according to the market. You're not going to get additional money if the market goes up, because it's going to be fixed. And similarly, asset backed securities, like just like we discussed, purchasing properties, purchasing houses, or purchasing, fixed assets. Okay. Again, those are also considered as fixed income securities. Maybe you can rent out the property and you can get a constant income, or you can you can mortgage your property, you can lease your property, or you can wait on your property and just sell it after a decade. Again, these kind of assets will be known as fixed income security, meaning you are guaranteed to make some sort of profit with those kind of investments. Any questions, any doubts so far from anyone?
No, sir.
All right. All right, let's continue then. Next. Now, diversification is the key. What does this mean? What does diversify means? Can anyone tell me what does diversify means? Diversifying or diversity or diversification? Okay. It means
Footprint.
yes, different varieties, different types. Okay. Different shades, different colors. Okay. Let's say you go to a supermarket, any kind of supermarket. Okay. Do you like to go to would you like to go to a supermarket where you will see all the products from one single brand? Let's say Britannia, for example. Let's take Britannia, for example. If you go to a supermarket, all the products that you see in that supermarket are from Britannia. You're not seeing any other options, meaning one type of biscuit, one type of cream biscuit, one type of chocolate, one type of chips, one type of this, one type of that. That's it. That is not very desirable, right? And that is not what supermarkets will do, because they know the customers are going to avoid them if they are going to do like that. But if they diversify, instead of just getting from one brand, they are getting from multiple different brands. It might be the same biscuit, but from different brand. So one biscuit from Britannia, another from McVitie's, another from Cadbury, another from Pepsi, etc. Now customer will see that, oh, they have a lot of different varieties. They are diversifying in their biscuit area. And customers will like to visit that supermarket because they know they have options. If they don't like this biscuit today, they are going to purchase that biscuit tomorrow. Similarly, you need to diversify your investment as well. You cannot invest all your money in one company and wait to make a profit. Imagine again, same example that we just took. Imagine 30 years ago, you invested all of your money. Let's say throughout your life, you have worked really hard. You are able to save 5 lakh rupees. Imagine that. You worked really hard and you saved 5 lakh rupees. 5 lakh rupees was a very big amount for you and you worked very hard. Now you have invested all that 5 lakh rupees in Yahoo. What happened today? Yahoo lost its value, meaning you lost your 5 lakh rupees. You only got 50,000 rupees back. But instead of doing that, imagine if you would have diversified your investment. Instead of spending 5 lakh rupees behind one company, you divided 5 lakh into 10 different companies, meaning 50,000 each. You invested 50,000 in Apple, 50,000 in Amazon, 50,000 in Google, 50,000 in Yahoo, 50,000 in Citibank, and 50,000 in Punjab National Bank, and 50,000 in uh, Bank of Maharashtra. Now, think what happened in last 30 years with all these companies. Apple went up. Apple became one of the richest company. Same thing, Amazon. Amazon went up. Amazon's founder Jeff Bezos for a very long time became the richest person in the world. Same thing with Google. Google diversified its business, and Google stock value is very high right now. Now Yahoo lost its value. Citibank again became a very big company. Punjab National Bank shut down because of a lot of scams. Bank of Maharashtra shut down because of a lot of scams. Now, but what happened here after you diversified? You made a lot of profit from Apple. You made a lot of profit from Amazon. You made a lot of profit from Google. You made a lot of profit from Citibank. Those 50,000 from four different companies, meaning 2 lakh, made you crores of profit. Okay. Now coming to the losses, you lost 50,000 rupees in Punjab National Bank. You lost 50,000 rupees in Yahoo. You lost 50,000 rupees in Bank of Maharashtra. Okay, overall you lost 1.5 lakh rupees, but still you made profit of crores because you also at the same time you have invested equal amount of money which turned out to become a very profitable company. So your 2 lakh rupees became really profitable. You lost 1.5 lakh rupees. Now, if you have made profit in crores, you will not care about that 1.5 lakh rupees you have lost, right? So that is why you have to keep in mind diversification is the key. Now, keep in mind if someone is telling you this is the company that is going to be next Apple, this is the company that is going to become profitable in crores within next 10 years, 20 years, don't believe them. Even the biggest, most successful investor in the world cannot predict which company is going to succeed, which company is going to lose. For last so many years we saw Reliance and Geo pick up the entire Indian industry. But if you look 20 years ago, Reliance was struggling very bad. It was very hard for people to imagine that Reliance or Geo will become such a popular company in India, such a profitable company in India. If you ask people in 2005 or 2006, they will tell you Reliance is losing business. No one is buying CDMA phones anymore because GSM was the market now. No one was buying CDMA phones. Reliance petrol pumps are shutting down. Reliance Trends, the clothing store is not working. Reliance is shutting down its stores. In 2005, Reliance was shutting down everything. They were not making profits. They were not making, their company was not successful at all. But now, out of nowhere, Reliance became one of the most successful company in India again. Similarly, same thing as well. India's Warren Buffett. I hope all of you have heard of him. Gautam Adani. Who would have thought 15 years ago Gautam Adani will become the second richest person in the world? No one. No one thought that. But again, no one thought his companies are going to succeed. But out of nowhere, his company succeeded. And at the same time, a lot of companies failed. A lot of companies have failed as well. Companies which people thought are going to be successful, super successful. So that is why I'm telling you, do your own research, take your own risk. Don't believe someone if they are telling you within 10 years this company is going to be bigger than Apple. Within 10 years this company is going to be bigger than Amazon. Whatever it might be, whatever company it might be. No one knows where the market is going. No one knows where what the situation is going to be, market situation is going to be after 10 years, after 20 years, after 30 years. You have to constantly research, you have to constantly diversify. It's not like you have 5 lakh rupees today, you have invested in 10 different companies and you are going to wait for 10 years. Every year you have to look into your portfolio. This is going to be your portfolio. You have to look into your portfolio every year. Look into your stocks. Okay, I have invested in these 10 companies. These companies are doing well, so I'm going to continue, or I'm going to invest more money in this company. This company is going in loss, so I'm going to stop investing, or I'm going to withdraw my money. Yeah, Sunil Khan, you have a question? Yes, can you hear me? Hello? Sunil, can you hear me? I don't think he can hear me. So this is why diversifying is very important, and at the same time, constantly looking after your portfolio is very important. When I say constant, it does not mean on daily basis, on weekly basis, on monthly basis. Keep it yearly basis. So let's say November 1st, you have invested something. l- Keep looking throughout the year, look at your stock, what's happening. But by next year, November 1st, 2023, decide which are the companies you want to continue investing, which are the companies you want to invest more money in, which are the companies you want to stop investing, which are the companies you want to take the money, whatever remaining from the stocks. So that is why it's always very important to diversify. Okay. So now here are some key factors. Diversification is the key to management of portfolio risk because it allows investors to significantly lower portfolio risk without adversely affecting returns. Same thing what I just said. It is important to diversify to make sure you manage your risk to lower your risk, okay, so that it will not affect your returns. Again, if you're looking at your portfolio, you're managing your portfolio. As soon as you saw that Yahoo is losing its money, Yahoo is losing its value, it went from 50,000 to 45,000, you will withdraw your money. You will withdraw before losing any more money. You lost 5,000 rupees, that is okay. At least you did not lose all your 50,000 rupees, or you did not lose 45,000 rupees and got only 5,000 rupees back. It's okay if you lost 5,000 rupees over there, but at least you can take that 45,000 after 1 year and invest in whatever company has performed, has profited you really well in last 1 year. So again, let's say you took that money back from Yahoo and invested that money as well into Google or Apple or Amazon or something. Again, your portfolio value is going up and you're diversifying your funds. Or instead, since you already have money in Google, Apple, and Amazon, you will find some other company that is maybe emerging in the market. Maybe you will invest in that kind of company, and again you're diversifying because you don't want to keep all of your money with one company or one type of company. So that is why diversifying is important. Next, international diversification is important. Now you have to look at all these things globally. Global things affect everything. It's not just going to be what's happening domestic or what's happening in India. It's not going to be like that. Whatever may happen in India. Everything is super successful in India, imagine that. But still there are a lot of things going on outside of India. For example, the Ukraine war that's going on, or for example, recently what North Korea has started doing. North Korea has started testing a lot of missiles. Okay, so that is scaring the people. And keep in mind, when people are afraid, whatever country it might be, it is going to affect the market as well. And at the same time, you should not only invest in domestic companies, you should also look into methods or ways of investing in international companies as well. Because again, diversification is the key. Imagine tomorrow if there is a recession, all Indian companies' value went down, meaning all of your investments have lost its value. Similarly, but if you have invested internationally as well, if Indian companies are affected, but imagine US companies are not affected, still it will mean that you're making money, you're making profit. Next, portfolio with 40 different stock is said to be the adequate diversification, meaning investing in 40 different companies is going to be very important. Give me 1 second. Yeah. So generally it is said that when you're investing money, it's important to invest in for around 40 companies. It's very important so that you will have a huge quantity of companies where you have invested maybe small amounts, not big amounts, small amounts, maybe 5,000 rupees, maybe 10,000 rupees, but you're waiting for a very long period of time, maybe 10 years, maybe 15 years, maybe 20 years, maybe 30 years. Maybe you're just looking for retirement. Some people do invest for retirement. They invest, usually they will invest around at the age of 24 or 25. They will wait for 30 years. At the age of 55, they will then look at their stocks which have performed really well, and generally in that scenario, people will have more than enough money to retire, to purchase, a house that of their dream, maybe go on world tours, maybe have a vacation, whatever they want to do. Now, here are a couple of tips for you to start your investments. Number one, use retirement plan. Okay, you have a lot of good retirement plans which are available in India, and I'm not just saying go with national pension saver or national retirement plan. There are a lot of retirement plans available from private companies as well, and they are monitored by the government as well. They are also known as ULIP, United Linked Insurance Policy. ULIP, use those plans as your retirement plans, because once you retire you can get lump sum amount of money, or you can get constant income. Number two, flee the bank, meaning don't, if you're a beginner, start with the bank, but once you start understanding the market, don't invest with the bank, because generally investments with a bank are going to be very low. If you have left your money in your savings account for 1 years, sorry, for 1 year, you might only get 2% of interest after 1 year. And even if you invested that money in fixed deposit, after 1 year, maybe you would have gotten like 5%, 5.5% interest back. Again, keeping your money in the bank or in fixed deposit, it is safe, but it's not making you any profit. And generally, a good investor would like to invest as much as possible. But again, keeping the risk in mind. It's not like you have all this money, take it and invest it. It's not like that. Be smart with your investment, diversify your investment, and be patient with your investments. Next, buy low expense mutual fund. Don't pay too much fees. Again, if you're investing in mutual fund, look at your options. Don't invest with the very first company that you come across, or very first mutual fund company that you come across, or very first bank that you talk to. Talk to multiple banks, talk to multiple different mutual fund companies, talk to multiple different investment bankers. Why? Because everyone have a different fee structure. Some people will charge you 1% of your profit, some people will charge you only 0.5% of your profit. Banks usually charge a lot. If you invest with a bank, they generally charge around 2.2% or 2.5% of your profit. Meaning, let's say if you made profit of 1 crore, bank is going to take 2.5 lakh rupees out of it. But if you have invested with someone who is only going to charge you 0.5%, meaning if you made 1 crore rupees, that person is only going to take 50,000 as their commission. Again, there are going to be some companies, some investment bankers who are only going to charge you 0.2% or 0.25%. So do your research. Don't invest as soon as you find a company. Talk to various different companies, do your research, and then decide which one is most suitable to you. Again, now keep in mind, cheapest are not always the best. Okay, some people might charge you just 0.1%. There is a great chance that they are not very intelligent, not very knowledgeable about investment as well. They are also starting, they want customer, that is why they are offering very low rate. So again, keep in mind, cheapest is not always the best. Do your research, look into the company, or look into the investment banker, or look into the mutual fund company. How long are they operating? How long have they operated? When did they start? How profitable are they in last 5 years? So for example, if you take brand new companies, like these days you see their commercials on TV. For example, 5paisa.com, they charge very low amount. They charge just 1.2 per 1 point, sorry, 0.12%. But if you actually look at the company's history, it just started 2 3 years ago. They're very new in the market. their performance is not that great so far. Meaning, if they take your money and if their performance is not great, then you are the one who's losing the money. That is why they are charging you very low. They want to gain customers. So always keep in mind, do your research. Just because someone is very cheap does not mean you're going to make a lot of profit. See how long have they been working in this industry, how long their company has been established for, how much knowledge do they have, how much experience they have, what kind of portfolio are they investing. Look into all those details. And last tip, as always, buy and hold. First of all, when you buy and hold, meaning wait for a very long period of time, like 5 years, at least 5 years, you're going to save a lot of money on taxes. Because if you withdraw your mutual fund or if you withdraw your investment profit within 3 years or within 5 years, government is going to charge you income tax on that. But you have invested for a very long period of time, let's say 5 years or 10 years or 15 years or 20 years, government is still going to tax you, but the tax amount will be really low. It's not going to be as high as it was if you withdraw that in 3 years. And at the same time, as I said, commissions. A lot of time companies have a frozen period, you can say. Okay, freeze period, where you cannot withdraw your money before 3 months or 6 months or 1 year or 3 years. If you withdraw that money, they are going to charge you 0.5 percent as fees, or 1% fees or 2% fees. Apart from commission, keep in mind, apart from commission, they're going to take their commission, and also they are going to give you penalty for early withdrawal. So try to invest for as long as possible, or try to at least invest for 5 years, so that you can get lower income tax, as well as the company will not charge you any penalty. Now, these are the important facts that you need to keep in mind before you go ahead and start investing. Only 33% of money managers outperform the market, meaning the money managers or fund managers or investment managers that we talked about earlier at the beginning of this webinar, not all of them perform really good. Only 33% of them perform really well. The rest of them are either making average money or actually losing the money. So you have to be very careful what company you're choosing, and what, even if the company is 20-year-old, look at the experience of money manager, and those companies will openly tell you whether this person has been investing for last 1 year, 2 years. Generally try to get someone who has at least 5 to 6 years of experience in investment. Okay, don't get someone who has recently joined the market, because they are not very much smart, they are not very much knowledgeable about the market. Now, second fact is, historically, stocks have returned 11% on an average, and bonds have returned only 5% on an average. Average, that is average, okay? Meaning, if you invest in stock, you get 11% per year profit. So, which means if you have invested 1 lakh rupee in stock, every year you're, on an average, you're making 11%. But again, it is very high risk. Not all companies will be profitable. But same thing, if you invest that in fixed deposit, on an average, you're just making 5% profit per year, which is half of what you're making in stocks. So generally, stocks are considered better, but at the same time, stocks are considered very high risk. Next, passive investment is the best way for most investor. Don't be aggressive. Don't be active investor, where you're changing your portfolio, where you're changing your companies on daily basis, on weekly basis, on monthly basis, or a quarterly basis, or on yearly basis. Try to be a passive investor, meaning where you slowly invest, you invest for a very long time, you make changes whenever necessary. You don't make change when uh, uh, constantly. You're only making change when it is necessary. Again, going back to our same example, you saw that Yahoo is starting to lose money. That is the scenario where you should change the company, leave Yahoo, invest in a different company. Okay, but Don't make changes on daily basis. An active investor will make small amount of money in short period of time, but a lot of time they will lose a lot of money. For example, if you take again example of Apple, you have invested 10,000 rupees in Apple 30 years ago. Okay, within 1 year, Apple is giving you 15,000 back. An active investor will immediately sell that shares because he's going to make 5,000 rupees profit. But if that person was a passive investor, that person waited for 10 years or 15 years instead of just 1 year, they would have made in crores instead of just 5,000 rupees. That is a very big difference between a passive and an active. Active, you can make money in short term, but the money is going to be very small amount. Passive, you're going to make slowly going to make money in a longer period of time, but the money is going to be for a very high amount. So that was the discussion about the basic knowledge that you should have before investing. Thank you so much. My name is Syed Mohyuddin. I was your presenter and host today. This is my number, email address, and LinkedIn. If you have any questions, please do feel free to talk to me about any of these. Now, do you guys have any questions, any doubts, anything that you would like to discuss? Anything? All right, then. Thank you so much for your time, all of you. It was really nice having this session, and have a wonderful day.